Hello ladies and gentlemen, and welcome back. Well, Michael Burry has been talking a lot about the stock market in 2022. In today's video, we have a comparison that might shock quite a few of you. On top of that, we now are less than 24 hours away from big earnings. And where do we find the stock market? At a critical resistance. It's right there, getting ready for a potential breakout that could instigate an extreme squeeze. We've talked a little while about the idea of making the market go up into either the 3880 to 3920 zone or even the 4100. The longer this kind of thing breaks out and the way it's creating itself right now, we have the real possibility of what we call an inverse head and shoulders. And if you take the distance of that particular inverse head and shoulders, you'll notice that it proofs right up into filling these gap ranges. So let's break down the markets together right now and talk about everything that's going on in the macro, technical, and of course fundamental universe right now with these markets. See you soon. Well, welcome back everybody to the Daily Show where we discuss stocks, commodities, and cryptos. As per usual, we'll go through the news, the macro data, the lead indicators, and then of course the key areas that you should be watching right now in the markets. But let's begin by discussing the Fed because they're expected to hike 75 basis points on November 2nd. And they should technically pause when inflation halves according to the latest Reuters poll. If we scroll down here, 86 of 90 economists have predicted that the Fed will raise fund rate between 3.75 to 4% next week as inflation remains high and unemployment is near pre-pandemic lows. Now, if we're talking about what is expected to happen into 2022, the markets are still expecting between somewhere around that 4.5 to 4.75% or higher by Q1 of 2023. So this is a big deal, and of course it's the current expectations. As this forward yield changes, we're going to see markets move considerably. Now the problem is, what do we expect in a sign of, let's say, this earnings? Do we expect that earnings being bad is going to be good for markets, or is it going to be good earnings is still okay? That's the problem. Some people are predicting that bad earnings or just slightly good earnings are both good, and that really good earnings are potentially really bad for the market. What a strange world we live in right now. Let's talk about Michael Burry for a second though, because he's been using a whole bunch of comparisons from previous times. And this is a great one. It's the VIX overlaid from 2006 to 2009, which we all know what happens. And then that's overlaid with the current VIX index of this year. Now, what you'll notice is a very similarity that we've always talked about. The idea that markets have not been able to breach a high VIX level. They've generally sat below that 35 level for 2022 so far. And generally when you're looking for market bottoms, of course now we think that there could be a rally, but that rally may be met by sell demand. When we're looking for market bottoms, historically, we've usually had capitulation, very high VIX fears. Now, if we take the kind of similar times and we think about where we're at and where we expect to be, around this period of time, we actually saw the VIX historically drop and then come into that December period here with an incredible spike of the VIX. Will 2022 live up to the same period as that 2008, 2009? Another similarity with that period to do with the VIX. So again, if everything's expected to squeeze, we're expecting VIX to drop here and then potentially a secondary mass fear level coming through later on this year. What an interesting time we live in if that's true. This is the comparisons of all the other markets. Again, if we take in consideration of all of the main bear markets, these have been mostly the areas where we've seen squeezes or at least pickups or the bottoms of markets. And of course, 2007, 2008 has been where we've had that capitulation. Maybe we're a little bit ahead in terms of maybe it's going to squeeze and then fall off later. That's at least a leading theory here in the markets. What about inflation? Is that set to drop right now? We've got absolutely no signs of that, but I thought this was an interesting chart just showing us the annual inflation projections by country in 2022. Look how bad it is in some of these countries. 284% inflation. It's just a nightmare. 210% over here, 155% over here. with some brutal inflation out there in the world. And when you compare it to many of the Western countries, so some countries are doing it incredibly shockingly. And that's just, it shows you how bad some of these situations really are. But let's talk about inflation and then recession. So of course, the Federal Reserve is raising rates. They're doing it at a pace that is pretty much a record. They're going hard, they're going fast, and they're going as quickly as they can to try to stop this inflation and taper it. When we're talking about recessions, sometimes they can be overblown, but this is a very interesting kind of average months until recession is ended up called in terms of lead indicators. So a lot of you would know by now yield inverted curves have been historically known to be a forward indicator, one of the best. Corporate profits also seem to be an incredibly forward indicator. That is profits dropping from the peak, 26.2 months until the recession is called. But what's most interesting is these ones that we get here, which is of course leading economic index, housing starts, and unemployment. When we start to see these move through, we're getting very close to the official recession call. And just remember this, once we get the official recession call, generally stock markets have already begun recovering. Isn't that interesting? So once we get the call, often the market will already be recovering. So this is some numbers that you may want to look at in the future to kind of predict maybe when bottoms have been forming. Historically, the market has bottomed before the recession has been called. That is the recession word is totally over, I guess overused and over discussed, but it's just so interesting to see those lead indicators and why you need to use the leads and not the ones that get closer to the point. The market already sniffs it out well before that. And of course, 2-year and 10-year have been inverted for some time, which we've discussed on this channel. The New York Stock Exchange margin debt percentage growth has decreased pretty drastically in 2022. It's actually been decreasing for quite some time. And when we've seen these decreases, a little bit of the time it's been either through the middle of the downward cycle or near the lows. You can see here middle in 1970s, low here in 1970 itself, and low again here in 2010 and 2003, kind of it was in the middle period. So once we see a reading like this, we can kind of say, well, is there any historical stats that are interesting? Well, we do have a couple of data points. We can go through those. And as you'll notice here, 1 month, 3 months, 6 months later, it can be a kangaroo style market. With actually a lot of the time with these data points, the market taking a little while longer to recover. And that's what we saw here with the 2001-2 reading. And then of course we saw a similar thing with the 2007-8 reading where we had a spike up in stocks, at least initially, and then we fell over making a new low later on. This is our most closely correlated market right now with what's going on in 2022. So margin is dropping and we usually see that kind of coincide with the stock market to a degree. So the drop in debt hasn't been too far beyond the S&P 500's fall. And this is the margin debt growth minus the S&P 500 growth. And you'll see it's kind of around the right level that it should be. It's not too crazy. The drop in debt has consistently been larger than the drop in stocks. So again, deleveraging is going faster than you would see in the stock market itself, which is interesting. It's not unusual to happen. Of course, we see big swings both ways, but we're now underneath that zone, or at least underneath that ratio. Let's talk about bear markets and seasonality. Now, we've discussed a lot about the idea that November brings the bulls. The back end of October, often into November, brings the bulls. Look at this though, when you take the bear market years versus all the years versus the bull market years. In bull market years, we go off, make new highs, it's all great, everything's green. In normal years, we go off and definitely do pretty well. But in bear market years, we tend to rally into kind of this period and then often drop sometime in November and start to struggle again. Very interesting. So if everything is playing the same kind of game, there's a real chance that we rally here, potentially drop sometime back of November. And remember, we saw with that VIX spike, that happened in December. Will it happen again in 2022? A very interesting stat here. And again, seasonality playing its way out through these markets. Smart money versus dumb money. A few of you have requested an update on this particular chart. You can see that dumb money continues to try to buy in right now. Smart money already started purchasing a little while ago through this area here, and they're holding on, but they're not purchasing incredible new amounts. And this is consistent. Usually when we've seen the turns this year, it's been somewhere around where dumb money takes over smart money. Smart money's dropping during the recovery. Dumb money continues to buy in. Once that crossed, we've seen some significant turnarounds. We'll continue to update you guys here on the channel as we see these play out. New lows are contracting. I won't go over this too much, but remember the percentage of the S&P 500 stocks registering 21 days lows was less. We had divergence of the stocks. Now, when we get these, it's a good reading. We got a lot of data points from this. And historically, it's begun a little bit of a rally followed by some weakness later on. Remember, 3 months later, we're now in week 2, week 3 of this. We've seen this recovery. We're seeing some strength, but overall, there was still more weakness potentially to come later on. And that's the thing. Only 56% of the time with all these data points, it was positive 3 months later. But it was way more positive 2, 3, 1 month later, that type of thing. When we go over the last 200 years of data, here's just a quick data point of all of the bear markets, so you guys can pause there if you're interested. And I want to bring up a Bitcoin stat here today because we are going to be doing a special video on Bitcoin as it's getting very interesting in these markets right now about what happens during these crypto winters. Now, we've had kind of 2 major big winters in the past, and what we saw was total supply in loss realistically peak in very similar ways in the past. Now, in 2018-19, we saw the highest level ever, and that coincided with that drop period. Remember, we've kind of discussed this a few times that we expect by February of 2023, based on previous cycles, for us to have seen the low in Bitcoin. Now, that doesn't mean we've seen the low now, but it means that in historical times, this is being kind of where you see those drop-offs and basings. Is this the base that then begins the rally, or do we have one final drop similar to 2018-19, which pushes us to that negative 83 to negative 86% decline levels? That takes us to around 11.5 for the US to 9.5 in terms of per Bitcoin. A very interesting stat and just another really, really interesting bit of information to kind of support that theory. In terms of earnings season, which we are in right now, we've got a 69% beat rate, which is very consistent with most good earnings seasons. Beats 179, misses 82. And the market seems to be relatively happy with earnings so far, though some stocks have, of course, totally screwed it up, which has been mostly around tech actually so far. Except for the Netflix. Tesla was okay, but not really within the high expectations of the street, and Snap was the big one. But it all changes as of Tuesday. We have big names. I mean, a lot of old school companies here on the left-hand side before the open, but the ones that I'm looking at, Microsoft, Google, Enphase, Visa, Spotify, the market will clearly be watching what happens here. Now, I couldn't tell you whether a bad result is a good result or a good result is a good result right now. It's a weird world we live in at this point, but you probably want like a slight beat, but not by much. And the expectations aren't exactly that high for this earnings season. They have come down quite a lot. But of course, all eyes will be, I think, especially on Alphabet. If I was to single out which one I think is the most important this week, it's got to be these two here. And that's because they are consumer discretionary. We want to see whether forward revision and whether demand has actually dropped consistently. So probably it's got to be Shopify, Amazon, and Apple that are the most important this week. That's just my opinion. That happens Thursday after the close and before the open. That could be one of those big kind of events where you see a huge explosion in stocks after the hours of those two results. What happened for the last session? Well, we saw a pullback in the morning. If anyone watched our live streams, which we tend to do every Monday morning leading into the US, we thought there was going to be a pullback, and there was, and the market went down 1%. Admittedly, I thought it would go down a little bit more, maybe 1.5 to 1.75% was my expectation of decline, followed by rally. The rally came in a little bit earlier, and we ended up slightly positive on the day, over 1% on most of the major markets. What was interesting about this, though, is the sector we saw coming out of the gate strongly in the morning continued to be the best sector for the day. And both of the top two were defensive, healthcare and staples. Now, this is not something we want to see continue if you believe this market's not about to turn around. You generally want things like technology, semiconductors, growth stocks in general leading the way, not defensive sectors. Healthcare and staples are defensive sectors. If they continue and we ramp up, and let's say we're hitting 3,900 and the best two performing sectors are XLV and XLP, it's very likely a short squeeze, and we need to be very, very careful around that. How have they fared though in the last couple of sessions? Well, it's not like XLV and XLP have been outstanding in the last couple of sessions, but in the last 24 hours, they put on a lot of this overall gains here. Again, the ones at the top are very good to have there because they're usually what you see during recoveries. Let's move now over to the stock markets and let's talk about how we're seeing a recovery here. Well, a lot of it has to do with these types of things. The S&P 500 stocks above the 50-day moving average moved down to like 3%. And that was usually one of those historical oscillator lows. Think of this like a lead indicator that shows you maybe a little bit of oversold markets. We've had this happen in June and we had this happen again at the back end of September, showing us that the market may be basing around that time. So far, so good, and a lot of stocks are now moving up. But we need to now set alerts for certain levels. I mean, if the market gets back up into these ranges like a 64 or something, that's going to be close to those average peaks that we've seen have turnarounds in them. So then the squeeze could be complete and the markets may, of course, turn back down. Definitely a chart you want to have on. Now, we talked about the VIX before and we said that Michael Burry's got a lot of overlays at the moment. Now, of course, he does. One of the big things he's discussing is this similarity. So the similarity leading into the absolute collapse of the markets and how the VIX continuously sat underneath that 35-40 zone, similar here to 2022 so far. Then it dropped off. It was the calm before the storm. And then we saw an absolute epic increase in fear, which coincided not necessarily with the exact bottom, but certainly coincided with a fear, which was a capitulation in the charts. The charts just fell off. The waterfall effect effectively occurred. Now, a lot of people bet on the VIX making a new high, as in going past a 45 plus to take us to a fearful low. Historically, that has been what has happened. So again, if the similarities hold up, the VIX should be dropping down right now, followed by potentially an almighty spike over the next 3 to 6 months. Will it happen? Time will tell. Let's talk about yields. Why is the stock market going up? Well, one of the cases could be made for the yield curve starting to soften. Now, this doesn't necessarily mean the Fed is pivoting. A lot of people are mentioning that again. But what it does mean is it's come off its high. 4.65% for the 2-year is now sitting at 4.5%. Now, if this drops under 4.4, you can see here it's been a strong level of previous kind of demand, or markets have bought that level and said, no, we think the yield's going higher. If it drops underneath, it could be a good sign that the markets are willing to squeeze a little bit more. And this has been what has coincided with quite a lot of rallies over 2022. When the 2-year started going sideways, we saw that really strong rally through the S&P 500 over that period. And that's what you want. You want a 2-year not going higher and either remaining sideways or, of course, declining. Either of those things should hold the keys to the market going more bullish. What about high yield bonds? Are they scared? Well, last 24 hours, they weren't exactly scared, nor were they that happy. They ended basically flat, and we continue to see here some consolidation on high yield bonds. And this is the same for corps. They're not really dropping too much, which shows us that the market is stabilizing for now and forming a base. Remember, if we see high yields make new lows and the stock market's chilling around, it's usually a precursor, a good kind of signal that the markets are going to weaken. What about TLT? A lot of people have been messaging me about treasury bonds. Yeah, it's pretty epic, these falls. Of course, these are the two levels that most people had on their charts as being potential demand zones. We did see some buying over here, but this one, we didn't even get a proper turnaround here. When the TLT came down to 102, it just got smashed straight through it. And it seems to be that it wants this 90 level with TLT. And this is crazy because when you think about it, and I will say that, the markets traditionally have bought treasury bonds, or at least held them relatively well through some crashes. In fact, people go searching that type of thing and searching that yield. If we go up here with the head and shoulders that happened earlier this year, the left shoulder, the head, and the right shoulder, it's predicting that Treasury bonds, because that's of course the neckline, should push down into that 90 area. And that's exactly where they have gone. They've gone all the way down into this zone. And we're not quite on all-time lows, you know, for treasuries that we've got here, but we're certainly coming into a super critical point. Will this be where the market actually starts to pick them up? It's probably crushing many funds right now with this incredible waterfall moment for treasuries around the world. People seriously dumping those, not necessarily the best sign that you ever see in the stock markets. Let's talk about the dollar index. What's going on there? Well, the dollar index continues to kind of sideways distribute, and potentially it's starting to move its way down. We saw a breakout over here that was followed by a peak, a trough, a higher peak, and then a lower trough, and then it rallied and sold off. Now that's the type of thing you do want to see. That's a tick. And it seems like each time it's coming up, it's being met by supply and falling off. If the US dollar drops, that is a good thing for the stock markets. I did think that we'd probably go a little bit higher. My thought process was probably going into around here. Didn't quite reach that and it sold off. But we're looking towards weakness here in the dollar index, strength in the S&P 500. This is the ideal kind of run through. And then realistically, that should come through quite a few other positions. If we go over and have a look at gold, you can see here that it did break out towards the upside recently. It's pulling back down the time of recording. And it's kind of come, you can make an argument both ways. I mean, it's often easy to do so, but how it looks like on a daily, let's just take a look at a daily. You can see all these rejections coming off these lows, and that shows us that there has been demand. There's definitely some form of buyer that wishes to potentially purchase gold at these cheaper prices. Now, when you consider where they're at in terms of overall, it's still, you know, a random level just in the middle here. It's been purchased so far. To move this around, what we're going to require is a market to make realistically a new high. But the good news is that we currently do have a bunch of wicks that have come through here. If the market can reverse in fairly quick fashion, I guess, with the DXY going down, then we push through these highs here at 1658 and we start to move, you would think, upwards of 1664. Once we get a new high out here above 1672, we should be looking pretty good for gold. Now, from the weakness side of things, if you're expecting gold to go down, I would still expect some buyers to show commitment around 1636 if we make a new low, and then potentially this to be where we face some proper demand coming back in for it. Be careful here in gold over the next 24 hours. I think a lot of markets are waiting for these earnings, and you can kind of tell they're all chilling around. The euro is something very similar. It's hitting into our supply zone. So again, we breach out this level. We could be on for a nice firecracker for the euro, going back to 1, DXY coming back down to maybe a 110.25. All of these levels kind of synergizing together. The stock market going bullish, risk on across the board. Where do we find ourselves ahead of the earnings? Right at the supply, right at the critical zone, waiting for most likely that news. US oil is all over the place. I still maintain the kind of overall negative bias here on oil over the next 3 to 6 months. So far, that has been pretty much the way it's been moving, and it continues to kind of weaken. Now, we saw a peak here, a trough, a higher peak, then we got a new lower trough, and each time it's come up to this zone just underneath 86, we've seen selling. So at the moment, that seems to be the main supply, and that seems to be where the sellers continuously commit. Could be a good zone to have on your charts, and to, of course, you know, understand what's occurring here. At this stage, oil still looks relatively weak. Now, Tesla moved below the low. So it actually went underneath 205. And then I think people like Cathie Wood started purchasing it pretty aggressively again. Or at least that's the report. And the market came back up. I'm still looking at Tesla weakening here. And I still feel like even with this bull market, while this is a good level for Tesla, don't get me wrong, I'm still watching this area here down in those 180s. I'm still targeting that. And it's not that I'm shorting into it. I just think that it's possible that Tesla at least moves down into these zones, potentially finds some bounce there. And then if it keeps moving down, a lot of people have talked about this 140 zone being a big one. Now, depending on what happens with the stock market over the next couple of months, if everything comes true and the market rallies and then dumps later on, of course, you would expect Tesla to probably find a level like that. It's at its support. It keeps holding it. You can see the daily close bullish with the wick behind. That's a good sign for buyers. but I still have this inkling feeling this 180 is very possible on Tesla. We'll find out whether that's true. Microsoft comes into earnings at resistance. No surprises there. Nothing much you can do about it. It's coming into earnings and it's at the resistance. Google is similar. It's structured up here. It's filled some gaps on the left-hand side and it comes in at resistance ahead of the earnings. It's funny how stocks do that. They're rallying in so that they can push that criteria or that agenda. Let's move over here to the DAX. What's going on there? Downward trend line, guys. And of course, we're not there yet, but this was one of those key levels that we were watching or looking for in markets. The DAX broke a new high. Again, that is a positive series of higher peaks and higher troughs coming through. There's nothing to hate about the DAX at this point just yet. The UK 100 is similar. Nice rallies coming off this crazy base. We've still got alerts here in the future, just in case we close underneath 6,800. If that happens, I think it could be a waterfall moment for stocks. We're going to have to continue to watch this. It's worthwhile doing so. Let's move over to the US markets in terms of indices. What's going on with the Nasdaq? Well, the Nasdaq's holding its best it can. And we haven't actually seen a new peak on the Nasdaq, which is interesting because we did on the S&P 500 we'll look at soon. And it's struggling right around the area that we've seen it struggle before. Now, what we don't want the Nasdaq to do if you're feeling bearish, you probably want it to just take the high, drop, and then go underneath this level here. So seeing as that was the low of the last 24 hours, we'll put a little alert there just in case the market does go underneath that, especially if it takes a high early, goes under here. This is a very likely scenario. If you're a bear, you are salivating on that idea. That's when you're smiling and feeling very good. But I don't think the Nasdaq holds the key here. It's most likely going to be the Russell 2000 and the US 500, which are mainly the indices I like to look at. And then if you want to trade the Nasdaq, fair enough. It gives you, of course, a lot of momentum and a lot of points in terms of moves. So we saw the Russell make a new high the other day, and it's come down. It's swung a new higher low, so a higher trough here, and it's put itself on the trend line right ahead of the big earnings on the other stocks, and it's holding as best it can with kind of like a little random pin bar kind of looking candle coming in. That's the downward trend so far. We haven't breached out, but if we do, we'll talk about it in the next 24 hours. Here's the US 500 though. This is the big one. Let's scroll down to the 15 minute. Now, if you're watching the live stream, we were talking about the idea that the market hadn't taken this random wick high. And the reason we brought that up is because if you look over, and it might take me a little while to get over there, guys, so we'll just quickly jump over here. If you look over at these previous periods, this was a previous basing that ended up being a huge sell. We get that little wick here, which most likely holds the orders, and then we have resistance selling each time it comes up. It's a very similar scenario with a very similar basing scenario. You can see here that low that gets formed into the rally, and this is where we were, and then of course that began the critical sell-off to where we are right now. So if we scroll over to where we are right now, you can kind of see very similar. We've rallied heavily each time, generally, into these market conditions, and this holds the key. If you're feeling bearish right now, I'm telling you, you could be pretty happy with what's going on here in the markets if it starts to fall off here. It's made the new peak, so this is a higher peak. So there's the peak, there's the higher peak. This is, of course, the trough. And what you're looking for is you want 37.20 to be taken out. And if that does happen, rallies should be met by sell demand. And everything changes in this market. At this stage, though, the bulls are still relatively committed. And once we take out 38.20, 38.19, that wick that's over on the left-hand side, we allow ourselves to be opened to the real squeeze levels, which is probably my preference case scenario. We've got here maybe a little bit of an inverse head and shoulders. If you take the distance from the peak to the kind of neckline, or the trough here to the neckline, you'll notice it pushes towards that 4100, which is where we have that gap. But both the 38.80, 39.20, and the 4100 hold serious levels for potential squeezes to get shorted off. And these are the two zones that we would actually quite like to see. It would make more sense to the current market, the current timing, the current seasonality, and everything around those ideas. What do you guys think in the comments down below? Let me know. Of course, if you disagree, that's totally fine. SPX, this is the coinciding kind of inverse head and shoulders, the big gaps that were left behind. Now, of course, there are other gaps that have been left, but it just makes sense that at least we try to squeeze into here. Now, if you look at the S&P 500 close, it actually wicked the high. So is that a precursor this market does want to go bullish? I still think earnings hold the key. If we go over to options and we scroll through to the 28th, which is the Friday this week, maximum pain is at 371, current price is at 378, and really the puts just seem to be sitting around 355, 358, 360. This is not the week we usually use maximum pain. That is the third week of every month, but it's still interesting to see where the options are. And as you go through to Wednesday, you'll again see 355, 360. These puts just slowly expiring worthless throughout the market. All the people that have 350 and 360 puts, unfortunately for now, doesn't seem to be working out. Now, we mentioned Bitcoin at the start of today's video. Unfortunately, there is not much for us to discuss other than Bitcoin's coming back down now to the equilibrium. And traditionally, this has been that kind of midpoint where the market has bought off. If you believe stock markets are going up, generally crypto will come with it. It's like a risk on asset at this time. But there's been quite a lot of trade volume and a fairly compressed price for Bitcoin. If it does fall through new lows, I could seriously see it collapsing. And this will be very, very brutal, I think, for a lot of crypto people if it does get to new lows. At this point, there's not much edge in this market, unfortunately, at least how I see it. It's mostly buy, sell, take profits at the equilibrium, that kind of point, and that's really all you can do. For the news ahead, there's not too much. CB consumer confidence comes out here at 10 a.m. New York time on Tuesday, October the 25th. Then we move through to a bunch of central banks and other discussion points around the world. We've got some advanced GDP for the US at 8:30 a.m. New York time. We've got the monetary policy statement for the EU. I'm sure that will be still something that moves the markets. The Bank of Japan outlook report and statement, that will be interesting. A press conference with the Bank of Japan later on this week. And the core PCE price index coming through on Friday, October the 28th at 8:30 a.m. So it's a mixture of huge earnings and a bunch of news coming out and central bankers everywhere telling us how great they are and how they're going to save the economies, yeah? We'll find out whether that is true. And of course, the market is going to do what it feels like. Remember, practice patience, guys. React. Don't predict if possible. If you're interested in more of those types of things, you can check out our advanced scalping masterclass. It really goes through a lot of these reasonings and why we are patient to wait for key levels and why that gives you better risk rewards. Thanks so much for watching. Subscribe, smash that like button, and we'll see you in the next video. Bye for now.